Hi, and welcome to CPA-sandiego.com. Let's talk about tax filing tips from CPA San Diego. Tax season is here again, and small business owners often struggle to not only file properly and avoid audits, but also to work the tax code to their advantage. Taxes are one of the most important issues facing small and growing businesses. And like a company's profits, its annual tax bill will in part reflect the owner's skills and knowledge. Business owners need to be sure that they are meeting all of their responsibilities and also seizing every opportunity to reduce their taxes. Here are some things to consider. Keeping good records is one of the most important things you can do. You probably hear this from tax advisors and accountants all year long, but proper record keeping year-round is the first step to ensuring your taxes are filed accurately and that you have the paperwork you need to back up your deduction claims should you get audited. Get your records in order. This is one thing many small businesses fail to do. Organization should be done throughout the year, not just last minute. CPA San Diego notes that understanding your deductions is imperative to proper tax filing. Know what deductions are available to you as a small business owner and know what you need in order to prove them. Again, record keeping is huge here. What small business deductions can you take? Do you have the documentation and original receipts to back them up? Tax credits and deductions change every year. CPA San Diego guides you through the deductions by asking you the right questions. Now let me tell you about understanding your employee classification. CPA San Diego knows that one very important item is how to properly classify employees in your business. Independent contractors and employees are not the same, and it's important to understand the difference. In the eyes of the IRS, misclassification can be seen as an attempt to avoid payroll taxes, and non-compliance can bring penalties and back taxes. The IRS provides guidelines to help shed light on the distinction and how to ensure you are classifying your workers correctly. Misclassifying workers as independent contractors can be costly. It is also important to understand your office space. The home office deduction is very specific, and not all home-based businesses will qualify. Likewise, if you run your business from a commercial location and claim the home office deduction, you might trigger some interest from the IRS. CPA San Diego shows that large sum miscellaneous deductions of itemized deductions relative to your income may cause the IRS to get suspicious. Likewise, if you bucket a large amount of miscellaneous expenses, you may raise eyebrows. Be specific and label every deduction. Keep business and personal expenses separate. The IRS scrutinizes personal expenses that may have been claimed as business expenses, such as the use of a business vehicle for personal use. Be diligent about keeping good records. Maintain a separate bank account and credit card account for your business. Next, let's talk about charitable donations. Charitable contributions made from business accounts, excluding C corporations, belong on Schedule A, itemized deductions. CPA San Diego notes that if you are a partner in a partnership or a shareholder in a sub-S corporation, the amounts of charitable contributions will flow to you from your Schedule K1. Charitable donations of business assets and inventory should be reported to your tax professional. These transactions are write-offs for your business. However, your time spent in a charitable activity, no matter how valuable it is valued at zero by the IRS, even if you miss work. Unless your business is a C corporation, charitable contributions typically flow through the business and are claimed as deductions on the individual tax returns of the shareholders of the company. That's true whether you're running a sole proprietorship, partnership, limited liability corporation, or S corporation. If you want to get the maximum tax benefits, you should know these basic rules. Only contributions to charities listed as qualified organizations by the IRS are deductible. Consult IRS publication number 78 for a list of qualified organizations. Contributions of more than $250 require a letter of receipt from the qualified organization, which many organizations have already. For contributions of less than $250, a canceled check is sufficient. In general, donations of property can be deducted for their fair market value at the time of the contribution. You cannot deduct a contribution that has already been written off as a depreciated asset. You cannot deduct the value of time or services that you volunteer. You cannot deduct the part of a contribution that benefits you. If you receive a gift in exchange for a charitable donation, for example, you can deduct only the amount of the contribution that exceeds the value of the gift. In general, you can deduct contributions only in the year you make them. Pledged contributions cannot be deducted until they are actually paid. For more information and to schedule a free consultation, please visit us at cpa-sandiego.com.